In this video I'm going to look at fixed asset management. This question was taken from one of my past papers, but a lot of the stuff is covered, if not identical questions, in similar questions that would have come from actual finals papers and so on. Okay, as the internal auditor, respond to each of the following scenarios. Number one, as the internal auditor, you've noticed that the directors have changed the value of land and buildings in the balance sheet. When you question them, they tell you that the premises were bought 25 years ago and their value has increased significantly over the time, and they want to reflect this to the shareholders. Explain to the directors whether this change should be made, and include in your answer your suggestion as to how the increase in value of land and buildings could be shown. Okay, you are not supposed to increase the value of fixed assets in the financial records because this goes against the historic cost rule. So they shouldn't have actually shown that increase in value. What you could do instead is you could show the increase in the value of land and buildings in the director's report. So in other words, you're telling shareholders, although the land and buildings are valued at a cost price, the more realistic market value is a much higher amount, and you tell them that in the director's report. Okay, number two, the CEO asks you how the fixed asset register assists you in maintaining good internal control over fixed assets, and state 2 points in your answer. Okay, with your fixed asset register, the values in the fixed asset register can be verified by physical stock taking of individual assets, and any assets missing can be determined. Remember, in the fixed asset register you have a page for each asset you own. So you can actually take that fixed asset register and go and identify all those individual assets and see whether any of them are actually missing or not. And then also details of individual fixed assets are kept in the fixed asset register. So for example, it will include the name of the asset, the cost price, the date of purchase, depreciation, and so on. And therefore individual assets can be monitored. So if you look at something like a vehicle, you can tell by looking at the fixed asset register the date it was actually purchased, to see the age of the fixed asset, and decide whether or not it would be more beneficial to replace that vehicle. Okay, number three, machinery is constantly breaking down, causing interruption to the production process. The machinery in question was purchased less than a year ago from a company that is owned by the brother-in-law of the purchasing manager. This company sells replicas of the machinery at a lower price than the original machinery sold by the company that invented the machinery. Okay, that's a clear case of nepotism, where the inferior quality machinery was purchased from the brother-in-law of the purchasing manager. In other words, the quality of the machinery was not considered, and instead the machinery was purchased just to benefit the brother-in-law. Nepotism, remember, is where you favor family or friends and you make decisions based on that rather than what is best for the business. So it would have actually been better to purchase the original make of machinery rather than a replica. You'll probably find, although the original make of the machinery costs a bit more, it's far more reliable and therefore better for the business in the long term. In number four, employees are taking home laptops that belong to the business over the weekend. The CEO tells you she is happy with this as long as the employees sign out the laptops. Okay, it is good that the employees are signing out laptops, so that is a good policy because it enables you to keep track of where those laptops actually are. You do, however, need to make the employees aware of the fact that if anything goes wrong, if the laptop's broken or stolen, then the insurance of the business is not going to cover the replacement of those laptops, so they would then have to be personally responsible for it. So yes, keep a register as you sign things out and back in, but make them aware that they are responsible. They take the laptops home at their own risk. And then lastly, suggest two other strategies apart from a fixed asset register, which could be implemented to improve internal control over fixed assets. Okay, there's lots of things you could mention here. Regular stock taking of fixed assets, where you count each individual asset and see that all can be accounted for. Make sure employees are not using fixed assets for their own use. So if you look at a company vehicle, for example, make sure they're not using the company vehicle by putting tracking devices or making them fill in a logbook. So they can't benefit for personal use using a business asset. Another one is to establish approval processes for additions or disposals of fixed assets. So in other words, when you want to purchase some fixed assets, you need to get approval from senior employees. Usually what happens is you ask to get 3 quotes whenever you want to purchase a fixed asset, and then you look at that and see which is the best one or best option for the business. And the same comes for the disposal of fixed assets. So if an asset needs to be replaced or sold, you need to get approval from a senior staff member. And then another one could be regular reconciliations between physical assets and financial records. In other words, just like you do bank reconciliation and creditors reconciliation to get accurate figures, the same thing here. You compare the actual fixed assets with your accounting records to make sure that the two things are in agreement. Just lastly, often you're asked to comment on fixed assets. So they give you a situation or a scenario. They might give you 3 different fixed assets and then ask you to identify problems relating to those fixed assets and thereafter to give solutions. The 3 things that you should always check for is look at the age of the asset. Often the asset is one of the assets is going to be quite old, might have a carrying value of R1, it may be very expensive to maintain and therefore should be replaced. So look at the age of the asset, look at the work ethic of employees using fixed assets. So if, for example, you're commenting on a delivery business and one of the drivers is constantly absent or doing very few deliveries, then that is a situation that needs to be rectified. The other thing that could be covered here is theft of cash that's handed in. So that I'll tell you, for example, they make so many deliveries and so much per delivery, and then when you multiply that out, you don't get the same as the cash that was actually handed in. So age of asset, work ethic of employee, and theft of cash. Okay, I have not gone through the other parts of fixed assets where you have to calculate cost price, accumulated depreciation, or the disposal of fixed assets. And the reason for that was because you had a question on exactly that in paper 1. So I very much doubt they're going to ask you the same thing again in paper 2. Okay, that's all for now. Thanks. I'm